It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, national underwriter for Old Capital. Joining me today is the man himself, the governor of real estate in the great state of Texas, Mr. Michael Becker. Michael, how are you?
Paul, doing good. How are things with you guys nowadays?
Going great. I mean, business is good.
Interest rates going down helping?
Absolutely, they are. I think it's bringing people back out of a cave that they've been hunkered down in for the last, say, 2 years, and they're starting to see maybe a little bit of light coming out, and they're going out to kind of explore. Is that a little bit of light, or is that the big bright sun that's coming out? So they're unsure. But ever since we got back from Las Vegas, Michael, I mean, we've seen interest rates go down significantly. Hopefully that's going to bring good news to have people think about buying and investing in apartments. So don't forget, if you're thinking about investing in apartments, two things I want you to think about. One is RSVP to the Old Capital bus trip. Old Capital bus trip, that's where you come from, wherever you come from. Come to Dallas, and we're going to spend all day together, and we're going to put you on a bus, and we're going to take a look at A, B, C different properties. You get the banker's perspective. Remember that we're bankers, and then we're going to tell you, some of the history of syndication, some of the history of people buying properties, what some of the things that went wrong, what you shouldn't do in the future. Spend some time with us and get to understand it's the best money you can buy, which is not very much at all, but it's not $25,000 or $30,000 to join, but maybe it's $100. But come to Texas and join us coming up here at the end of March 28th. Go to oldcapitalpodcast.com, oldcapitalpodcast.com. People absolutely love it at the Old Capital bus trip. And then coming up April the 9th, I don't know if you've ever heard of this guy, but this is a guy that you definitely want to hear from. Gentleman's name is Jeff Adler. Jeff Adler, we met him out in Las Vegas. We spent probably about an hour with him. He's with Yardi Matrix. He's kind of the guy who tells folks a little bit about what the future lies in apartment investing. Talks about demographics, talks a little bit about what's going on with the market itself, where you should be investing in. So we subscribe to Jeff and his team over at Yardi Matrix. You want to listen to him. He's going to be in the Old Capital Speaker Series, which is going to be a virtual on April the 9th of 2025. April the 9th, 2025. It is going to be a Wednesday. Again, it's going to be virtual, but to sign up, you've got to RSVP. Again, to the oldcapitalpodcast.com. Sign up the Old Capital Speaker Series for April the 9th with Jeff Adler. A great discussion that you'll be able to ask questions on. So let's talk to Michael. Michael, you had a big win or success this week. Tell us a little bit about what happened. And don't brag, please. I don't like braggers.
But the deal we bought?
Yes.
Yeah. So we ended up closing the first deal of the year. Then with a little bit of a whirlwind deal, we ended up partnering for the first time with a very large kind of institution fund out of London. And man, it was a whoop, Paul. Nothing's for free, but we entered in a pretty large joint venture with them. Closed a deal in kind of suburban Dallas, and it was it was quite a protracted process to start, but pretty short trigger. Closed the deal. Very complex, very large legal bill. That was kind of, one thing to know this is another thing to experience it. So I kind of think I knew that going in, but it's great. So we got a little vehicle with them. So we're hopefully buy a few more properties. We got our first one on the board. Thought it was a pretty good, compelling basis, and it was good to get some activity going. It just feels good to get one on the board.
How did you guys find that deal? I mean, are you still knocking on a lot of doors? Are you talking to people? Are they calling you? How did you guys find this deal?
It was actually a marketed deal. It was with a large national firm, and they had a 7-property portfolio out in various markets. So they went out in the fourth quarter. So a lot of the deals that went out in the fourth quarter, kind of rate cut happened in September. So kind of your post-Labor Day is always a big push of listings. So this year, post-Labor Day, got the benefit of a rate cut, and then all of a sudden the treasury rates went up 100 basis points almost over the next 3 months. So all these deals had, reasonably high expectations because the rates were being lowered and the actual borrowing rates went up. So a lot of these deals didn't trade because they wildly missed pricing expectations because people were expecting lower rates and the rates did the opposite. So this one not only had that, it also was part of a 7 property portfolio. So very large kind of headline number because you had, I don't know, a few thousand units in there. And they weren't very homogeneous markets. So you had one in Dallas, one in Austin, and like Georgia and Tennessee and stuff like that. So bigger is not better nowadays. Well, smaller tends to be a little better. So they broke up. Most of them didn't trade, and this one did. And so kind of just like following it and realized that people that were bidding on it were all institutions and they weren't going to buy a one-off deal. And for whatever reason, they didn't get the word out to many kind of my competitors that are similar profile and size to SPI, didn't quite pay attention to it. And we just kind of tracked it and it seemed cheap. And we've been talking with this group out of London for a long time and kind of was entering into a joint venture and kind of fit the metrics that they were looking for and kind of cut the deal. So it was actually just a marketed deal that no one was paying attention to.
And those deals happen that sometimes transactions that could be the best deals are the ones that have been overlooked by other people.
Yeah, because they were whispering hi, Paul, and then they think it was a portfolio, maybe breaks up. And then, they started calling me. I hadn't toured it. So then my phone started ringing, asking me to go tour it. So when that happened, okay, they need people to tour it because they're not getting much action. So it was kind of my clue to really start, get my ears perked up.
Can you talk a little bit about a pro tip? And it came down right before you guys signed your sales contract. Again, this is inside information, but a pro tip would be you wanted to get a price reduction. And what did you, like, nothing's for free. So what did you have to do to be able to get a price reduction?
Yeah, so the rates actually were going up when we got awarded the deal, and our partner required an adjustment in price, or they were going to not do the deal, and I needed them to do the deal, so I had to go back. So we ended up putting up, we had a relatively short timeline. We had to agree to a pretty short timeline, and then we had to double earnest money. So we went non-refundable. So I think we went from 800,000 to 1.6 million, or 750 to 1.5 million, or something like that. So we doubled the earnest money. That went non-refundable and removed an extension option and had a really short timeline. So it put a lot of pressure on us. We got it done, but it was, compressing 60 days of work down to like 28, I think. And, but we got it done and it all worked out, and it was great to have the lender we done 4 or 5 loans with prior. So I had a lot of confidence, and we kind of raced through and get it all done.
So again, you had to put up more non-refundable earnest money. And then for that, you were able to get a large price reduction.
Yeah.
Is that right?
That's right. Yeah. Kind of pro tip, you think about it, when any negotiation, you usually got to give something to get something. So I had to give more surety and shorter timeline. So more earnest money, a shorter timeline. And then we got price on it. And then as soon as we did that, then rates just started ticking down like immediately thereafter. So it was kind of dumb luck, blind luck there, but it just kind of worked out.
Better to be lucky than good, I always say. So the question really today that people are asking, it was a question that I heard when we did our speaker series this week, was a little bit about immigration and just the whisper about what's going on. Since the border's really been kind of shut down, what type of impact is this having on tenants in some of these workforce Class C properties? And you guys have kind of changed your profile, but what is just what you're hearing from your property management groups, other investor groups that own Class C properties? What are you hearing out there these days?
Yeah, I haven't really thought about that much. And then NMHC, 3 or 4 people asked, kind of in conversation that came up 3 or 4 times, and I started thinking about it. And largely doesn't really impact what we own, because we don't really own much of that anymore. Got a couple older deals, but never in like super areas that'd be super impacted by that. And just started thinking like, immediately that's going to hurt construction and might cause pricing and replacement costs to go up just because you have fewer variable labor. But I actually did have a conversation. I have a conversation every week with our property management company, and in passing on that conversation, they don't manage much of this stuff either, but they do have one client owns a property in the Blockman Lake area of Dallas. That's one of the more denser, older vintage apartment stocks concentrated in one little location. And so he was kind of mentioning how they've been running this deal for a few years, and it's been 98%, like rock solid 98% occupied forever. And ever since Trump got in, it went to like low 80s, like pretty much overnight. So I think there's some real impact to that. So just kind of depending on the pocket and demographics and whatever of the area is something that I would be very aware of going in and make sure that you kind of goes eyes wide open, because these properties that maybe have been 100% for perpetuity maybe won't be going forward.
That is absolutely true. That's something to concentrate on in this workforce housing space, is that if you take a look at rent rolls for last 6 months or 90 days or so, you may see 100% occupancy for the last 60 days. It may have fallen. So keep that in mind if you're looking at the Class C properties in the workforce areas, that I don't know if it's going to be a short-term deal that you may see a dip down in occupancy, but I can tell you if we went back to 2007, 2008, just beginning of the Great Recession throughout the United States, but especially here in Texas, we were building homes prior to that like it was going out of style. People were building these $195,000 or $230,000 homes, and all the trades were busy. The roofers, the guys that were putting the plumbing in or the drywall, all these guys that are tenants in a lot of these Class C properties, they were very, very active. Recession comes in, lending's no longer available. People stop building houses. There goes the jobs and the trades. And so one of the things that you'll realize when you get into workforce housing, especially in the Hispanic area, is that sometimes one unit just may have one family, but you may look at 2 units down or 3 units to the right, to the left, around. They may be all interconnected with same family, but different last names or so. So if someone decides that they want to move back to Mexico, one family does, that may have an impact on the rest of the family picking up sticks and moving back to Mexico. So just understand a little bit about the dynamics of apartment managing and operations. Is that, again, if you, what's that phrase? The toes you step on today may be connected to the ass you're kissing tomorrow. That is important, that if you throw somebody out in one unit, it may have an impact for their mother or their sister-in-law, their brother-in-law at the rest of these units. So
that's a new little saying, Paul. I never heard that one out of your mouth. I thought I heard them all from you. That's a good one.
So, but you were talking a little bit about workforce housing. I mean, are we starting to see a lot of workforce housing come out there? I mean, tell us a little bit more about what you're seeing out there, too.
Yeah, it seems like the last 30 days, we kind of post NMHC. There was nothing at NMHC on the market. And then there's been last, 2, 3, 4 weeks. So we'll push of listing some newer stuff, but I think even more in the workforce housing. And so just, trying to track everything that, thinking like, is there time to do kind of a migration back in time and buy some older stuff, so kind of thinking of that topic you just talked through. That's certainly a consideration when we're looking at stuff, but just kind of tracking these older deals. And it seems to me that there's been a big push, and virtually every one of them, the 80% of them at least, we're all kind of being priced. The guidance is debt plus closing costs, maybe like a small margin above debt. So just a little bit over the debt basis. And these are the people that are kind of out of time. They just got to go sell it, and they're just trying to clear their debt and not have a foreclosure on the record, or, have to work it out with the lender or whatever. And I'm not sure how many of them, in my estimation, are going to clear the debt. Seems like in a lot of these cases, they're a little bit, overvalued. So we'll see. Like, it seems like we have the same conversation in 30, 45 days from now. I think it might finally be like the moment where values kind of get reset on the older stuff, and that kind of is like pervasive across the market. It's not just no volume. There actually might be some volume or some failed sales that couldn't hit that number, or maybe people push because the rates are falling and they can push pricing up, and maybe it pulls a rabbit out of the hat on some or most of these. I don't know. It'd be interesting to see, but it to me, on the way we kind of just do down and dirty underwriting on these, and they just aren't making any sense at the guidance. So we'll see.
You're blessed that you get invited to a lot of different functions in the real estate community, and I'm appreciative that you are able to share some insights. You this week, not only were you closing on this large transaction, but you also went to the Marcus and Millichap IPA, which stands for Institutional Property Advisor Group. You went to a conference, I'd like for you, if you could do me a favor, just share some information about what you learned at that. And I know that there was a lot of charts and graphs, but maybe you can just paint some pictures on in people's heads about what you learned.
Conference would be a little aggressive term for what we did. It was a bird hunt, and then we had dinner.
Well, I wasn't going to go there, but tell everybody what that means.
So you go out at a hunting resort lodge and go shoot some birds, and you hang out and have dinner and cocktails afterwards. And over dinner, just kind of talking. So the room had probably around 30 clients, Paul. All the Texas team was there for PA, and then about 30 of their clients. I would say of the 30 clients, there was like 3 apartment owners, me and 2 other guys, and 27 developers basically in that room, because they focus predominantly on brand new construction. So they sell a lot for merchant builders. So most of the household names in Texas that you would know were in that room.
And these guys are building apartment buildings.
Yeah, building. I don't know if I should be saying names, but all the household names that build apartments in Texas were in that room. Big volume shops all the way down to kind of smaller independent merchant builders, and everything kind of in between. So that was kind of who was in the room, who the audience was. Some takeaways were just kind of had a little kind of kicking it around. One of the questions was around construction costs. Seemed a little bit of relief, and it's not really in materials, it's not really in labor, it's not in land. What's kind of coming is their subs, the subcontractors, their profit margins are getting narrowed basically. So they're having to pay their trades the same, but they're starting to run out of work because the starts aren't starting like they have been. And so it's kind of keep the lights on pricing is kind of what they're seeing. And you're starting to see a little bit, obviously, when rates come in. Banks are also not loaning a whole lot of money. A lot of these banks have some payoffs. So they're starting to see spreads compress on some construction lending. But, kind of quantifying that, it seemed like the group thought maybe, 3% plus minus maybe will come off construction costs. So it's not, not moving 10% or anything like that, but they're going to see a little bit of margin relief. Now the feedback was they've seen some trades blow their pricing out too around tariff fears, like some of the appliances and plumbing fixtures and light fixtures and things like that. People are kind of preemptively trying to put tariff pricing in, and they've been able to push back to date. But if those actually get implemented, I think they seem to think that'll wipe away whatever savings they have on some of the margins for some of the subs and make the values go up. So it's kind of interesting. So there might be a little bit of relief, but it's nothing appreciable, and it's just in margin on some of the vendors. They're talking about just the debt availability is much greater for construction loans than it was, 12 months ago, for example. So debt is readily available and pricing has come in, but they still cannot attract equity, in any sort of large scale. So equity is still not there, which makes sense to me because the deal we bought, one of the guys in the room is building, a little townhome product just north of the deal we bought. I'm not saying, I don't know if it's adjacent, but within 1,000 yards of our property. And he's, I don't know, 65,000 a door, 70,000 a door, at least higher in his costs than what I bought my deal for, so he didn't want to hear me tell him my comp price on the deal we bought. So that was, and guys like me that buy, below replacement cost, it just kills equity wanting to invest in ground up and take all that risk when you can buy below replacement cost. So until we see some pricing rebound on the Class A stuff, which I think is starting to happen in real time, it's going to be hard to attract capital. The other thing that's been hard to is kind of set your rents. Like, where's your rents on your 2 years in the future on this deal you're building? Because you're still seeing kind of rent declines across the board on new lease trade outs. I think that's kind of been pretty minimal here in recent past. And, my crystal ball is when this comes out, basically it's the 1st of March, give or take. And spring's here. I think rent growth starts like right now in Dallas and maybe a little later in Austin. But I think we're going to start seeing some rent growth because a lot of these buildings have delivered and kind of getting full.
Do they talk a little bit about the significant decline of apartment construction in Texas? And did they talk anything about if they compared the 4 food groups of Austin, Dallas, Houston, San Antonio, and how big of a decline it has been?
Yeah. Actually, they sent the slide deck, and pretty dramatic. So kind of seems like I'll go through all 4 out of the slide here, but seems like basically back to, they think that we're kind of starting to deliver units in the same number that we delivered in 2014 in Dallas Fort Worth. And you probably go back to 2013 for kind of annual deliveries, what they're expecting this year in Austin. And, like Dallas Fort Worth is probably, I don't know, 1.3 million, more people in population than it was in 2014, 11 years ago, something like that. So these are pretty meaningful decline. The chart specifically showed that, say in Dallas and Austin, both the peak quarter, it was kind of like quarter over quarter supply. The peak quarter of new deliveries in Austin and Dallas both were Q2 of 2022. Excuse me. Yeah, new starts was, the peak quarter for starts was Q2 of 2022. Austin's had 7,300 units starting Q2 2022. And Q4 last year, 24, they had 1,800. So it was down 75%. Dallas had 17,000 starts in 22, and then last quarter was 4,600, down about 72%. Houston had 7,700 in Q3 22. That's down to 2,000 last quarter, 74% below. And the most amazing one is actually San Antonio. Also was a Q3 22 peak that had 4,000 units start in Q3 2022. Last quarter, they had 300 units. So like one deal started, it's down 92%. I mean, talking with those people in the room. So we own some deals in San Antonio. It seems like no one's going to build a deal in San Antonio ever again. Talking to that room. So probably not reality, but it's going to probably be 2028 before you start seeing supply and scale in San Antonio, because the rents are lower than Austin and it's still expensive to build in San Antonio, especially on the west side with some topography that you gotta do retaining walls and stuff. So that's kind of what's fueling the optimism right now, Paul, is like the starts are down. The peak was 2 quarters ago. I've been saying this in a different way, like about Q2 2025 is when we should really see all these deals be absorbed and really start going. So I mean, we're kind of done with the new deliveries in Dallas Fort Worth, at least the large number, be much more manageable. And Austin's probably 6 months behind Dallas, and no supply and population still growing. As long as the economy holds up reasonably well, we should see rent growth, and that should be like now.
So really, when you compare people that own houses, pay mortgage payments versus someone living in an apartment building, I think the delta of the cost between the two is surprising. And a lot of people maybe don't understand is that if you live in an apartment building, typically you're going to get Class A property. You may get all brand new appliances. You may get different type of amenities on the property besides that rock climbing wall and the gym that's on the property versus just a house. With interest rates that have gone up on the home lending side, if you were to take out a home loan and try to get 90% leverage on these deals because you can't put a lot of money because you don't have it to buy a $800,000 or $900,000 house these days in Austin. But you're talking about a big delta between somebody that has a mortgage payment and somebody that's paying rent. And Mike, can you talk a little bit about that? I don't know if you had a slide that kind of talked a little bit about where people put their head down on a pillow every night, who pays what makes a difference about where they live.
Yeah, I mean, I think in all 4 majors in Texas, all 4 major markets, it's still over double the cost, the mortgage relative to the equivalent rent. So it's twice expensive on a monthly basis to have a home, not in addition to, obviously, like you said, having to come up with the down payment and all the maintenance and all that stuff yourself. So I think that's still driving, renter demand in general. So until that kind of normalizes, and with interest rates coming down, that will, lessen that to some extent, with rental rates going up as we start rising, raising our rents. And I can't wait for that. Thank God, after a tough 18, 20, 24 months here, we should start seeing that. So that gap will narrow. Right now, it's still very wide. So it's making the rent to buy ratio more favored than the renter because it's much more affordable. And I think that's going to kind of help fuel, future demand as well.
Anything else any kind of common knowledge that you got off of the hunting/conference
that
you thought was important that maybe people should know too?
Yeah, I mean, I think just those guys still were pretty down, which I think is good for guys like me, that they can't build, they can't start these deals. Still very challenging. So I welcome them being challenged to start new stuff, because we need to have, 3 quarters of lower deliveries. But, I mean, it still feels like everything I've been saying for the last 18, 24 months is like, it's been hard, coming up almost here in a week or two. I think it's been 2 years since First Republic and Silicon Valley Bank failed. And ever since that moment, it's been virtually impossible to capitalize a new construction deal. And the peak was prior to that. So we're finally seeing the tailwind. I'm kind of hearing, looking at some other opportunities out in the marketplace right now and kind of got a deal. I think the deals that are going to make the most sense for us right now are these deals that for the next, month or two is the deals that went to the market in Q4, Q3, Q4, right, post Labor Day, right when the interest rates started rising after the interest rate cut, the treasuries went up. Most of those deals didn't trade. They all failed. And some of those guys got to go. Like they got to sell it because they have whatever pressure on them. So when they go back out, if they go out and they don't go wide, I think they're going to not see price discovery and the benefit of these lower rates that we're living in now. So I think your best opportunity to find a relative value is in that kind of subset. Those deals that went out failed and now they're back out. So I think that's of the nicer, newer stuff. So that's kind of really where my attention is, to be super specific and topical. And that's a window for 30, 45 days, and that's going to close. It's going to be something different. Because I'm hearing some of these deals that are out right now and calling for offers that, now the rates are down. All these institutions are back in a big way in Dallas and Texas. So I think if you guys follow our friend Jay Parsons on LinkedIn or X, he had a note recently about how Avalon Bay just bought 8 properties in Texas, 6 in Dallas Fort Worth, 2 in Austin suburban. They had a high 475 cap for all of them. They're there. Then I know there's this big deal in Frisco that's being bid. And what I understand, there's 6, 7 institutions in the middle of beating each other up to see who can pay the most. And it's every 2 to 3 letter household name of institutions, and they're, bidding it up right now. So I think there's, I think all those guys you listen to talk kind of publicly, they're all saying second half of 2025, they're going to get active, and it kind of call them bullshit. I think they're all trying to front run each other. And I think they're all back right now. And I think people are going to pop their head up in 60, 90 days and see some of these trades that are getting set as we speak right now on the brand new Class A stuff. And the pricing is going to gap up. So that's what I think is happening in real time. I think we're basically back. I think rent growth, I reserve the right to be wrong, but I think we see rent growth in Dallas Fort Worth right now. So when you see in May and June, the March, April, kind of May rent growth numbers, I think they're going to be positive in Dallas Fort Worth. And I think it's going to catch some people off guard.
Well, that's a lot of information that you learned shooting birds and having a couple steaks.
Maybe a cocktail or two along the way,
or a cocktail or two. But, that's at the players level. That's what the stuff is you get invited to when you do some significant business in the apartment business. If people want to know more about what you do, again, what do you do, Michael? What is Strategic Property Investments, SPI Advisory? What do you guys do?
Yeah, main focus is just buying high quality, relative, good price, relative to the market valued apartment deals in North and Central Texas, basically. So mainly focused on Dallas, Fort Worth, and Austin right now. And Dallas is a little bit more transactional. Austin's a little more frozen, but we're just trying to buy high quality opportunities that are mispriced and take advantage of them. Right now, it feels like we're about to see pricing start moving up on the top of the grade, and maybe the workforce housing is going to finally get reset, and that will recover a little later. But we're just trying to find that, put it out for investment opportunities. So we obviously always welcome people's interest. Anyone that's interested in the space of buying Texas multifamily. If you want to learn a little bit more and kind of see the opportunities when they come available, or get on our list for quarterly newsletters that we write, I would just encourage you to go to our website, which is spiadvisory.com. That's www.spi like spyadvisory.com. There's a contact form you fill out and get in the database and get the newsletter and see opportunities as they come. But that's we're excited, Paul. We're lean in, going all in, super aggressive. I think we're starting to move up, and I think it's go time.
So if somebody were to invest with you, again, we're just talking off the cuff here, $100,000, $250,000, $500,000. I mean, what
typical minimum is $100,000, Paul. So just that, and obviously welcome more if that's of interest. But that's typical minimum. We're doing 506C raises for those, and in the know. So that's the Reg E 506C exemption is what we offer when we raise capital.
What does that mean for somebody that's not familiar? There's a 506C and a 506B. What do you guys do?
So we could take any accredited investor is allowed to invest in our deals. We do not accept non-accredited investors, meaning you have to have a net worth of $1 million or more or certain income restrictions. You guys can Google that or listen to one of the former episodes where I'm sure we talked about that ad nauseum.
I'm sure we did.
Yeah.
So some great information, Michael. Thank God you didn't shoot off your foot with shooting birds. So we appreciate you spending some time with us on the Ask Mike Mondays. So let's go out and have a great week. I'm Paul Peebles. Have a great day.